Welcome to Tikona Capital FinServe's Market Outlook for July 2025. I'm excited to share our comprehensive analysis of current market trends, opportunities, and strategic insights that will help you navigate today's dynamic investment landscape. At Tikona Capital FinServe, we empower our customers to invest in high-quality businesses and build long-term wealth. As a SEBI-registered research analyst and mutual fund distributor, we provide data-driven insights and personalized investment solutions. Our philosophy centers on creating finite solutions in an environment of infinite financial possibilities. Disclaimer: Tikona Capital FinServe Private Limited, SEBI registration INH 0000098807. Investments are subject to market risks. This is for educational purposes only, not investment advice. Please read all documents carefully before investing. Visit tikonacapital.com for details. Today's outlook covers 10 critical market themes. First, how US deficits drive global trade patterns. Second, India's FDI weakness and urgent policy needs. Third, Brent oil's volatility factors. Fourth, the ongoing de-dollarization trend. We'll also examine equity markets, mutual fund performance, IPO activity, sales momentum challenges, credit cycles, sector valuations, and whether fundamentals are catching up to market prices. Here's a key insight: when the US runs higher trade deficits, global trade actually picks up. Current tariff tensions could create a new export cycle for countries like India. Our export strengths lie in machinery, chemicals, and gems, while we import primarily mineral products and weapons. Smart investors should track US deficit trends as early signals and focus on export sectors with strong US demand. India faces a concerning FDI challenge. Total foreign inflows dropped to $50 billion in free 2025 from a $79 billion peak in free 2022. Both FPI equity and debt flows turned negative due to global risk-off sentiment and rich valuations. FDI has fallen to just 0.74% of GDP, a 20-year low. India must revamp its FDI playbook by easing exits, speeding clearances, and targeting high-growth sectors like AI, green tech, and manufacturing. Brent crude faces a perfect storm. Demand is weakening. US gasoline demand fell 2.3% year-on-year in June, while China's crude imports dropped 8.6% month-on-month. OPEC Joe extended cuts, but compliance is questionable with Russia exceeding quotas. If Brent breaks below $65, expect inflation relief globally, benefiting airlines and logistics, but pressuring energy sector earnings. The de-dollarization trend is accelerating. The US dollar's share in global reserves has fallen to 46% in 2023 from 60% in the early 2000s. Gold now represents 20% of reserves, the highest in over 25 years. This shift toward reserve diversification, driven by geopolitical tensions and inflation hedging, represents a fundamental change in the global monetary system. GST collections show cooling momentum. June collections of 1.85 lakh crore rupees grew 6.2% year-on-year, down from May's 16.4% growth. While April hit a record 2.37 lakh crore rupees, the month-on-month decline indicates weaker consumer sentiment and geopolitical uncertainties affecting domestic demand. This trend deserves close monitoring as an economic indicator. India's macro picture is mixed. PMI rose to 58.4 in June, a 14-month high, driven by export demand and job growth. However, core sector growth slowed to 0.7% in May, while industrial production moderated. The bright spot: CPI inflation fell to an estimated 2.5 to 2.6% in June, continuing its benign trend. Trade deficit narrowed to $21.88 billion as imports declined. Indian debt markets show resilience. After RBI's surprise rate cut, 10-year yields climbed to 6.33% before settling at 6.28%. June saw record corporate bond issuance with spreads rising modestly. Bank credit growth moderated to 9.6%, but NBFCs and microfinance showed strong 20% growth. Banking system liquidity surged to 3.74 trillion rupees, the highest since June 2022. Commodity markets remained volatile in June. Gold prices peaked at 10,151 rupees before easing to 9,726 rupees by month end. Brent crude averaged $63 to $65 amid demand concerns. The rupee showed remarkable stability, trading in a narrow 85.28 to 86.93 range against the dollar. Foreign exchange reserves climbed to $702.8 billion, approaching all-time highs. Equity market outlook. Mutual fund performance varied across categories. Small-cap funds led with 3.8% monthly returns, followed by contra and mid-cap funds. In debt, credit risk funds yielded highest returns at 0.5% monthly. Thematic funds showed mixed results, with transportation leading at 4% monthly returns. Silver fund of funds excelled in hybrid category with 5.8% monthly performance. Global markets showed divergent trends. Nasdaq led with 5.9% monthly gains, while European indices lagged. Indian markets performed well. Small cap indices gained 4%, with 3-year returns of 30.1%. IT and pharma sectors led sector performance. Strategy indices showed Nifty 200 Alpha 30 topping monthly charts at 6.5%. IPO activity remained robust with strong investor appetite. June saw significant issues including HDB Financial Services, 12,500 crore rupees IPO with 17.65 times subscription. Most IPOs were oversubscribed, led by Globe Civil Projects at 80.97 times. Fee flows turned positive at 20,424 crore rupees, while de-inflows remained strong at 45,519 crore rupees, supporting market momentum. Let's examine the IPO market activity and investor sentiment in detail. Moving to our investment strategy and future market outlook. A concerning trend emerges in corporate sales. Free 2025 top-line growth slowed to 8% from 25% in Free 2022. Key sectors show weakness. Auto sector declined 2%, it grew only 4%, and FMCG managed just 6%. With margins potentially peaking, investors should shift focus to companies with volume-led visibility rather than those riding purely on cost efficiencies. This credit cycle differs from previous booms. Unlike the 2000s when 30% plus credit growth drove capex booms, current credit expansion hasn't translated into investment or consumption surge. The deleveraging hangover persists, creating structurally weaker credit cycles. Investors should prioritize asset-light sectors and consumption themes while monitoring infrastructure plays for recovery signs. India's gaining global market weight. Our share in global market cap reached 4%, well above the 2.8% average. India's up 8% year-to-date in USD terms, outpacing US and China. This outperformance, supported by resilient domestic flows, offers buy-on-deep opportunities amid global volatility. India's relative strength positions it well for continued global investor interest. Auto sector fundamentals face headwinds. Despite trading at discount to long-term averages, Q1 demand shows weakness, two-wheelers down high single digits, passenger vehicles up 2 to 4%, and commercial vehicles flat. Export risks persist. While valuations offer comfort, weak demand and margin pressure suggest holding off fresh entries until clearer recovery signals emerge. Promoters are capitalizing on the bull run. In just 1 month, promoters and large shareholders offloaded shares worth over 45,000 crore rupees. Major exits included Bharati Airtel, ITC, and Indigo, each exceeding 11,500 crore rupees. This broad-based monetization across sectors reflects confidence in current valuations. Portfolio managers expect these funds to eventually return to markets. Sector outlook shows mixed signals. Auto trades at discount despite weak demand. Banks face margin pressure from rate cuts. NBFCs trade at premium expecting robust growth. Cement shows strong investor interest but modest demand. Technology stocks trade at premium, awaiting new tech cycle. Metal supported by stable prices. Healthcare maintains premium valuations. Consumer staples show steady demand with gradual rural improvement. Global economic pulse shows mixed signals. India's GDP growth at 6.5% outperforms global peers, with inflation at 69-month low. RBI cut rates by 50 basis points with liquidity surplus at 3.74 trillion rupees. Global growth forecast at 2.9% with major economies decelerating. Trade tensions and geopolitical risks dampen sentiment, while the dollarization trends persist. Our investment strategy: 70% equities, 20% debt, 10% alternatives. We favor financials, defense, CDMO, EVs, and infrastructure while staying cautious on FMCG and margin-pressured sectors. We maintain bullish stance on Indian equities with selective mid-cap bias. Monitor global volatility and sector rotation for tactical opportunities while focusing on quality businesses with sustainable competitive advantages. Investment strategies mentioned are indicative and for educational purposes only. Actual asset allocation should be based on individual risk profile, investment horizon, and financial goals. Please consult certified financial planners for personalized investment advice. At Tikona Capital FinServe, we believe in creating finite solutions in infinite possibilities. Our triangle logo represents filtering out unknowable edges from the ultimate circle of market uncertainty. Connect with us at tikonacapital.com for personalized investment solutions. Thank you for watching, and invest with conviction, build long-term wealth. Remember, all information presented is for educational purposes and represents our views as of July 2025. Tikona Capital FinServe is a IMFI registered mutual fund distributor. Investments in securities markets are subject to risks. Past performance does not guarantee future results. This presentation does not constitute investment advice. Please read all documents carefully and consult your financial advisor before making any investment decisions. For detailed disclosures, visit our website at tikonacapital.com.